Many of us were taught that the stock market is risky. You probably have that aunt, uncle, or cousin who always says, "Don't invest in the stock market, you'll lose all your money." Who doesn't, right? But here's the interesting part. Even though the stock market is volatile in the short term, it has almost always generated profit in the long term. So, why? Today I'll explain this in the simplest and clearest way, step by step. And at the end of the video, don't forget to send it to that relative who needs to hear this. Let's begin. Point 1. When companies grow, the market grows. The stock market is basically a big place where many companies come together, and these companies have one goal: to grow. They open new branches, create new products, and reach more customers. So what happens when a company grows? Its profits increase. And when profits increase, the stock price goes up. That's why long-term investing in the stock market is basically becoming a partner in the growth of companies. As the economy grows, companies grow. And when companies grow, stock prices rise. Point 2. Time reduces uncertainty to a minimum. I won't lie, yes, sometimes the market crashes. 6 months can be terrible. A year can be flat. But for centuries there has been one undeniable truth. Unless a country's economy completely collapses, the stock market always trends upward in the long run. Why? Because over time, good years balance out the bad ones. What falls today recovers tomorrow. Time erases risk. That's why long-term investors almost always win. Point 3. Consistent investing. You know what the best part of the stock market is? You don't need to invest at the perfect time to make money. Slow, steady, consistent investing is enough. For example, imagine investing $250 every month. Some months you buy at the bottom, some months at the top. But in the long run, your average cost balances out. This is dollar cost averaging. Simple, but one of the most reliable strategies even professionals use. Point 4. If the economy grows, the market grows. If a country's population is increasing, consumption increases, technology advances, businesses expand. All of this pushes the stock market upward. The stock market doesn't belong to one person or one company. It represents a country's entire production power, business capacity, and future potential. That's why, over the years, stock markets almost always end up higher. Point 5. The biggest mistake. Thinking short term. People think the stock market is risky because they only look at the short term they want, quick money. But 1 week, 1 month, or even 1 year movements are just noise, random fluctuations. The real potential appears in the long term. In summary, the stock market may look chaotic in the short term, but in the long term it reflects the growth of companies. If you're patient, invest consistently, and think long term, not making money becomes almost impossible. Let me know in the comments which financial topic you want to see in the next video.